Hello everyone. In today's video, we'll be studying chapter 3 Intangible Assets. So let's begin. An intangible asset is an identifiable non-monetary asset without physical substance. So in the last chapter we had studied tangible assets, that is basically the assets which can be seen and touched. Intangible assets are the exact opposite. That is, they do not have any physical substance. These are non monetary assets without physical substance. Like, for example, goodwill, brand name, trademark. It's not something which is a physical item, right? So these are intangible assets. So in that, some examples are license and quotas, intellectual properties, brand names, trademarks. All right. Now, for an asset to be identifiable as intangible assets under the standard of IS 38, there are two criteria. First is that the asset should be separable, and it should, or like it's either or, the asset should be separable, or it should arise from any legal or contractual rights. Alright, so what does it mean? So to be separable means that you should be able to separate the asset from the rest of the business. You should be able to buy the asset, should be able to bought or sold separately from the rest of the business. All right. And second is, it arises from legal or contractual rights. Like, for example, company A is acquiring company B. Now, during that consolidation process, the goodwill of company B will also become the part of company A. So in that case, the goodwill, which is an intangible asset, has arisen from contractual right, from legal right. All right. So the two criterias, it should be separable, that is, you should be able to separate the asset from the rest of the business. um you should be able to buy or sell the asset from the rest of the business. And second is that it arises from legal or contractual rights, and that usually arises when in the process of acquisition. All right. It will also meet the normal definition of an asset, that is controlled by the entity as a result of past events, a resource from which future economic benefits expected to flow. Pretty simple. Now, recognition. When do you recognize it in the financial statements? So you can recognize it when it meets the definition of intangible asset, and it meets the recognition criteria. That is the same criteria for which was applicable in tangible assets as well. That is, the cost should be measured reliably, and there should be some future economic benefits flowing to the entity from the asset. You should have probable flow of future economic benefits, and the cost of the asset should be able to be measured reliably. So if these criteria are met, then the asset should be initially recognized at cost. Alright. So same as tangible assets itself, initially you recognize it at cost, and subsequently there are two models, that is cost model and revaluation model. And also, if an intangible asset is purchased separately, it should initially be recognized at cost. Again, same logic. Initially recognized at cost. Subsequently, you can choose cost model itself or evaluation model. Cost model is basically you recognize the intangible asset at its cost minus any amortization and any impairment losses. Alright. So it is carried at cost less amortization and any impairment losses. The model is commonly used in practice. Amortization works as depreciation. So just like how we depreciate tangible assets, amortization is the same name as depreciation, but it's for intangible assets. So intangible asset is amortized over the useful life, with an annual expense being shown in the statement of profit and loss each year. Now, for tangible assets, almost all the tangible assets had a definite useful life. But for intangible assets, it may not be the case. The useful life may be finite or indefinite. Because, for example, goodwill, you can't really assign a useful life for it. But for example, a license, that can have a useful life, because like license, it's, let's say, for 5 years, 10 years. So not all intangible assets have a finite useful life. So if the intangible assets have a finite useful life, then you have to simply amortize the asset over its useful life in the same way how depreciation works. But if you don't have a useful, if you don't have a quantifiable useful life itself, in that case, how would you amortize it? So in that case, you have to check for impairment every year. You have to check whether there are any indicators of impairment suggesting that probably the fair value has reduced. Fair value is basically the market value. If it has reduced, then you will have to impair your asset in the books. So if it's a finite useful life, then intangible assets with finite useful life must be amortized over that life, normally using straight line method. An intangible asset with an indefinite useful life, it should not be amortized, and you should test for impairment annually, and more often if there is an indication of possible impairment. Okay. Now, the revaluation model. Intangible asset may be revalued to a carrying amount of fair value less subsequent amortization and impairment losses. Okay. So here you are revaluing it at fair value less any subsequent amortization. Fair value should be determined with a reference to an active market. What is an active market? An active market is a market where there are significant amount of transactions happening, like large volumes of transactions are taking place, and uh, like the products which are being traded are homogeneous. So it's very difficult to find an active market for intangibles because, let's say for example, brand name. A brand name is not homogeneous, right? It's different for every firm, or it's different for every company. So it's quite difficult to have an active market for intangibles. So an active market is a market in which transaction for the asset take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So these are very technical terms, but basically large volumes of transactions are taking place, so it's easy to get the prices. IS 30 states our active market for intangibles are rare and specifically prohibits the revaluation of patents, brand names, trademarks, and publishing rights because, as I mentioned, uh, like homogeneous items are dealt in active market, and it's difficult to have an active market for brand names, trademarks, patents because these are unique, right? It can't be replicated. So, as a guide, indicators of active market would include the items traded within the market are homogeneous and prices are available to the public. Most intangible assets have value because of the uniqueness and therefore unlikely to be homogeneous, as I mentioned before. Certain licenses may fit this model and could possibly be revalued, but most other intangible assets will not. So, you have to also carefully decide whether the revaluation model will be fit or not, because in order to be able to adapt the revaluation model, you need to know the fair value, and fair value is obtained from active market. But if the intangible assets is very unique, it's not homogeneous, then it's difficult to have the active market. Then probably you would not be able to adopt the revaluation model, and you'll have to go with the cost model itself. So that is a factor that is to be considered while selecting which model to be used. So basically, a quick recap. Intangible assets are initially measured at cost, subsequently can be measured using cost or evaluation model. Cost model, it is the asset is carried at its cost less any amortization or impairment losses. If the asset has a finite useful life, simply amortize it over the useful life, same as how depreciation works, that is, charge the amortization in SOPL and reduce the value of the asset by the amortization expense every year. But if it's indefinite useful life, that means you don't have a quantifiable number itself for which you can amortize. So in that case, you would not amortize it, and you would test for impairment annually. You would check whether there are any indicators of impairment and confirm whether the fair value has dropped. In case of revaluation model, you will carry the asset at its fair value less any amortization and impairment. You would obtain the fair value from the active market, but active market can be rare for intangibles. So in that case, you would have to carefully choose whether revaluation model is fit for that asset or not. Now, Internally generated intangible assets. Generally, internally generated intangible assets cannot be capitalized as the costs with these cannot be identified separately from the costs of running the business. Now, examples of certain intangible assets which are generated internally within the business are goodwill, brands, mastheads, publishing titles, customer list. Now, you can't mm, see the criteria for intangible assets were that it should be separable and or it should arise from legal or contractual rights. Now, if the asset is generated internally, like for example, goodwill. Now, inherent goodwill, which is generated internally within the business, you can't assign a value to it separately from the business. Like, you can't say the goodwill of this business values $5 million. You can't quantify a value for it, right? The value of goodwill can be quantifiable when it is being acquired. That is, in the case of acquisition, when company A is acquiring company B, then when you're purchasing company B, goodwill also comes along with it. But company A cannot assign a value of its own goodwill. How will you quantify it? So in these cases, internally generated intangible assets are not capitalized at all. You can only capitalize it if it has a unique, if it has a value to it, or you can you have obtained it in the process of acquisition. Brands. Accounting treatment for brands has been a matter of controversy for some years. IS 38 Intangible Assets has now ended the controversy by stating that internally generated brands and similar assets may never be recognized. Okay? Because you can't distinguish it from the cost of the rest of the business. How will you assign the value to the brand and not separately from the business? It's not really possible, right? So how, because the condition also says that you should be able to as the cost should be able to be measured reliably. If you can't value itself, then how would you measure it in the books? So that's why internally generated assets are not capitalized. Now, how should the following intangible assets be treated in the financial statement? Publishing title acquired as part of a subsidiary company. Now, the answer depends on whether the asset can be valued reliably. If this is possible, the title will be recognized. Otherwise, it will be treated as part of the goodwill. So, simple logic is that if you can assign a value to it, sure, go ahead, capitalize it. If you can't, then it would come in the process of acquiring the company anyways, but in the form of goodwill. All right. License purchase in order to market a new product, you can definitely have a value for the license, that is the contract amount or the contract term period. So it has been purchased separately and so it can be capitalized. Now, goodwill. Goodwill is the difference between the value of the business as a whole and the aggregate of the fair values of its separable net assets. So let's say the business totally values $10 million and just the assets value is, let's say, 8 million. So in that case, the remaining would be goodwill. That is, you can assign a value to it by taking the difference between the value of the business and the value of its net assets. Now, separable net assets are those assets and liabilities that can be identified and sold off separately without necessarily disposing of the business. This includes identifiable intangible assets as patents, licenses, trademarks. So, separable net asset. What does the word separable mean? So you should be able to sell that asset separately without selling the business as a whole. Like for example, plant, machinery, licenses. You can sell those assets separately and you don't need to sell the business for it. So these are separable net assets. Fair value is the price that would be received to sell an asset or pay to transfer liability in an orderly transaction between market participants at the measurement date. Very fancy definition, but basically means the value that you would get in the market when you're buying or selling a certain asset or paying for a liability. Basically, the market value of an asset or a liability. Goodwill may exist because of any combination of a number of possible factors. Now, it could be reputation, expertise, favorable contracts, or good management. Purchased goodwill. It arises when one business acquires another as a going concern, that is the case of acquisition, which I mentioned before. Includes goodwill arising on the consolidation of a subsidiary, will be recognized in the financial statement as its value at a particular point in time is certain. A plain read of this is enough. It's not very important, and anyways, this would be dealt in detail in consolidation chapters. Non-purchase goodwill is also known as inherent goodwill. It has no identifiable value, so it cannot be recognized. So only the purchased goodwill can be recognized in the books, and inherent goodwill or non-purchased goodwill you cannot capitalize it in the financial statements. Now, IFRS 3 business combination. IFRS 3 governs accounting for all business combination and deals with accounting treatment for goodwill. Um, this would be dealt properly under chapter 18, but we can just have a quick read now. Goodwill is defined as an asset representing future economic benefits arising from assets acquired in a business combination that are not individually identified and separately recognized. Again, very complex, fancy definition, but it's basically the difference between the business as a whole and the separable net assets. Negative goodwill. It is gain on a bargain purchase. Is treated as income as the purchaser has paid less than the fair value of the identifiable net assets. For now, just remember that negative goodwill, it is treated as income, and this happens when, so the fair value of the assets, let's say, is 8 million, and the purchaser has paid 6 million. So in that case, a 2 million is negative goodwill because the purchaser has paid less than the fair value of identifiable net assets. Okay, so non-purchase goodwill, it cannot be recognized at all because it does not fit the definition of the framework criteria, that is, you cannot have a value to it. Now, research and development. Now, these are some very fancy definitions of research and development, which you can give it a plain read, but it's not really required. Just remember the accounting treatment though. So, research expenses, all the research expenses are expensed in profit and loss. Okay, these are to be recorded in profit and loss. But development expenditure, you can capitalize a development expenditure when all of these conditions are met. And these conditions are pirate conditions, PIRAT, that is a short form for these conditions, it's like an acronym. So P stands for probable flow of future economic benefits. You should be able to get some benefit from the asset in the future. Now that can either be through revenue, that is through sale of products, or some cost savings. All right, some economic benefit should be there though. Okay, next, I, there should be the intention to complete the entire development of that asset so that you can use it for its intended purpose. Okay, so intention to complete. R, you should be able to measure the cost reliably. Simple. R. A, you should have the necessary resources, an adequate level of resources to be able to complete the development. T, uh, the development should be technically feasible. So, technical feasibility of completing an intangible asset so that it will be available for use or sale. And E, expected to be profitable, that is, the cost of the project will exceed the benefits generated. Okay, so all the research expenses are expensed, research expenditures expensed in SOPL. Development expenditure can be capitalized, but only when all of the pirate conditions are fulfilled. Every one of them have to be fulfilled. And um, so uh, so until all the pirate conditions are fulfilled, until then the development expenditure is also expensed in SOPL. Once the pirate conditions are fulfilled, then the development expenditure can be capitalized, and the development expenditure which had been expensed in profit and loss, Once it has been expensed, then you cannot reclassify it as an asset in the SOFP. Only after the pirate conditions are fulfilled, only that can be capitalized. Okay. It is only expenditure incurred after the recognition criteria have been met which should be recognized as an asset. Development expenditure recognized as an expense in profit and loss cannot subsequently be reinstated as an asset. So, if the expenditure you're already expensed it in SOPN, then you cannot reclassify it as an asset. Once expensed is done, you cannot change that again. Okay. Now, suppose plant or machinery has been used in the development process. The depreciation on that plant that can also be capitalized as part of the development cost. Okay, let me repeat. If an item of plant is used in the development process, the depreciation on the plant is added to the development cost in intangible assets during the period that the project meets the development criteria. Okay, so if in the development process a plant is being used, until the development expenditure has been completed to qualify the pirate conditions, until then the depreciation on that plant can be included in the development costs. Okay, it is added to the development cost and intangible assets during the period that the project meets the development criteria. Okay, so remember that you have to include it in the development costs. And amortization, so amortization begins when the asset is commercial, when the assets commercial production begins. Okay, when the development expenditure should be amortized over its useful life as soon as commercial production begins. So you'll amortize it and charge it in SOPL. Okay, make this test your understanding. So an entity has incurred the following expenditure in the current year: 100,000 spent on initial design work of a new product. It is anticipated that this design will be taken forward over the next 2-year period to be developed and tested with a view to production in 3 years' time. So this is in very basic stage. It is just in the design stage, and it will be taken forward to develop within the next 2 years. So it is not in the development stage. It is just in the research stage. So this will be expensed in profit and loss. Second, 500,000 spent on testing of a new production system which has been generated internally and will be in operation during the following accounting year. This system should reduce the cost of production by 20%. Now, this is a testing stage already. This is no more in the research phase. This is in the testing phase, and it will also reduce the cost by 20%. That is, you will be able to get some economic benefit. So this is in the development stage. Okay, so this can be capitalized as development expenditure. YU 2, an entity has incurred the following expenditure during the current year: a brand name relating to a specific range of chocolate bars purchased for 200,000. By the year end, a brand specialist had valued this at 250,000. Remember that brands are not homogeneous, so an active market does not exist. So you cannot use the revaluation model, it has to be held at cost model. So that means that it has to be kept at 200, it should be valued at 200,000 itself, but you should if it has a finite useful life, then you have to amortize it over its useful life. If not, then you have to test for impairment annually. Okay. Second, 500,000 spent on developing a new line of confectionery, including 150,000 spent on researching the product before management gave approval to fully fund the project. Now, 500,000 is the total cost, in that 150,000 is on research. So which means that's divided into two parts. Out of 500, 150 is on research and the remaining 350 is on development. So 150 has to be expensed in profit and loss and the 350 can be capitalized. Training costs for staff to use a new manufacturing process. Training costs remember that even in chapter 2, tangible assets, I mentioned that training costs are always expensed in profit and loss. This cannot be capitalized. So training cost of 100,000 would be expensed in SOPL. Let us solve these TYUs. So Copa PLC has spent 20,000 researching new cleaning chemicals in the year ended 31st December 20XO. They have also spent 40,000 developing a new cleaning product. So this is on researching, and 40,000 is on developing a new cleaning product which will not go into commercial production until next year. The development project meets the criteria laid down in IAS 38 Intangible Assets. Now, 20,000 is spent on researching. So the 20,000 will clearly be expensed in SOPL. 40,000 is on development of a new product. So this is development expenditure and it can be capitalized. But it will not go into commercial production until next year. So which means that you cannot amortize it yet, because amortization only begins when the commercial production begins. So 20,000 will go in SOPL, 40,000 can be capitalized, but amortization can't take place until next year. So that would be C. 40,000 should be capitalized as an intangible asset and should not be amortized. 20,000 should be written off to statement of P&L. Okay. Which two of the following items could potentially be classified as intangible assets? Purchased brand name, yes. Training of staff, no. Training expenses are always expensed. Internally generated brand, no. Internally generated intangible assets, you cannot assign a value to them, you cannot measure them reliably, so they are not capitalized at all. License and quotas, yes. Now, SAM company has provided the following information as the 31st December 2006. Let's see the question. Which of the following adjustments will be made in the financial statement as the 31st December 2006? Okay. Now, Project A. 50,000 has been spent on research phase of this project during the year. Research, so which means that this is clearly in SOPL. Now B, 80,000 has been spent on this project in the previous year and 20,000 this year. Now this project was capitalized in the previous year. However, it has been decided to abandon this project at the end of the year. Now 80,000 was capitalized last year and 20,000 was spent this year as cost. But they are planning to abandon this project. So if you're abandoning the project, then the cost that you had capitalized, you would have to write it off. So which means that 80,000 which was capitalized, that would be expensed in SOPL, and this year's 20,000 would also be expensed in SOPL by default. Which means total 100,000 would be expensed in SOPL. Okay. So this is totally in SOPL. Okay. So 100,000 is in SOPL, and that 80,000 you have to write it off from the assets. So minus 80 from assets. Okay. See, 100,000 was spent on this project this year. This meets the criteria for IAS 38. So they've clearly told it. So this is in SOFP. Now see, total in SOPL. What is the total in SOPL? Project A is completely in SOPL, so 50,000 plus 100,000 in SOPL. So this means 150,000 in SOPL. In SOFP, it would be minus 80,000 of last year that you have to write it off, and plus 100,000 of project C. So this would be 20,000. Okay. So this one, reduce profit by 150 and increase NCA by 20,000. Now, which of the following statement concerning the accounting treatment of research and development expenditure are true according to IAS 38? Research is original plan and investigation undertaken with the prospect of gaining new knowledge and understanding. Yes. Development is the application of research findings, yes. Depreciation of plant used specifically on developing a new product can be capitalized as part of development cost, yes. Remember that I told this point that during the development phase of a plant and machinery has been used, then the depreciation on that can be capitalized as part of the development expenditure. Expenditure once treated as an expense cannot be reinstated as an asset. Yes, once if you have expensed a development expenditure in the SOPL, you cannot reclassify it as an asset in SOFP. Already, once is expensed, it cannot be classified as an asset. So all are correct. Now, which of the following should be included in a company's statement of financial position as an intangible asset? Internally developed, no. Internally generated, no. Expenditure on completed research, no. Research expenses are always expensed in SOPL. Payments made on successful registration of a patent, yes, because patents can be capitalized. You can assign a value. Now, the remaining three questions, I would suggest you all try it out independently. So we have completed this chapter, pretty straightforward chapter. If I have to quickly summarize it, is basically that intangible assets are assets without physical substance. You have to it must either be separable or arise from contractual rights. Separable is that you can buy or sell it separately from the rest of the business, and contractual rights is usually in the process of acquisition. When do you recognize it? You can recognize it when if the cost can be measured reliably and probable flow of future economic benefits. Initially, you have to always measure it at cost. Subsequently, you can follow cost model or evaluation model. In cost model, you have to recognize it at its cost, less than amortization and impairment. If the asset has a finite useful life, amortize it over the finite useful life and charge the expense in SOPL. If there is no finite useful life, then obviously you cannot amortize it. Then in that case, you have to just check for impairment annually. Revaluation model. Now, revaluation model can only be applicable if there is an active market, that is, a market where significant volume of transactions take place and pricing information is available, and the products dealt in the market are homogeneous. But in case of intangible assets, these are usually not homogeneous, like brand names, trademarks. So in that case, revaluation model is not really fit most of the times. But if it is applicable, then in that case you have to value it at a fair value less any impairment and amortization expenses. Internally generated intangible assets are never capitalized because you cannot assign a value to them. It cannot be measured reliably. Like, these are not separable. You cannot assign a value to it separately from the rest of the business. So any internally generated intangible asset, you cannot capitalize it. Um, Next, purchased, non-purchased goodwill. If it's a purchased goodwill, that is from acquisition, then you can capitalize it. But if it's non-purchased, that is inherent goodwill, then you cannot capitalize it. Negative goodwill is the case. Firstly, it is treated as an income, and it is the case when you are paying less than the fair value of the identifiable net assets. So that is negative goodwill. Now, research and development. All the research expenses are expensed in SOPL. Development expenditure can be capitalized, but only when all the pirate conditions are fulfilled. P stands for probable future economic benefits. I stands for intention to complete. R stands for to be able to reliably measure the cost. A is for adequate resources. T is for technical feasibility, and E is expected to be profitable. So only when all the development expenditure fulfills the pirate conditions, you can capitalize it. Until then, you have to expense it in SOPL. And once the expense has been expensed in SOPL, you cannot reclassify it as an asset. And if a plant or machinery has been used during the development process, the depreciation on that can be capitalized in the as part of development expenditure. Amortization will only begin when the commercial production begins. Okay, so I've summarized the entire chapter as well, and we've also solved few MCQ questions. So That's all from my side for chapter 3, Intangible Assets. Pretty straightforward chapter. Thank you so much.